Hey, everybody, and a special hello to all you Mad Money fans. I'm Melissa Lee. Jim is off today, but you are in luck. We've got a special edition of Fast Money lined up for you. We're calling it the Fast Five. We are counting down on the 5 hottest stories that impacted your money this week. Here for the countdown, Tim Seymour, Dan Nathan, and Brian Kelly is back with us. Let's get right to it. And we begin the countdown with the race to reopen. All 50 states now back to business in some form or fashion. This even as U.S. deaths from the coronavirus continue to rise. On Wall Street, stocks push higher as the nation opened back up. And while initially many were quick to condemn those who oppose stay-at-home measures, there seems to have been a major swing in sentiment lately. Check out what former Goldman Sachs CEO Lloyd Blankfein tweeted. He wrote, "Hospitals are not overwhelmed. Most of us will be exposed anyway since we can't sequester until there's a meaning vaccine. And we know which groups need protection from worst outcomes. Is the public health benefit from broad lockdowns at this point worth such extreme damage to livelihoods?" And this all, of course, goes to the debate about what is more important, the potential human lives lost, which are, of course, very important, or the toll on the economy and possibly irreparable damage to the economy. Tim Seymour.
Well, look, Mel, if you think about where Lloyd Blankfein was on April 24th, I follow Lloyd on Twitter, by the way. He doesn't tweet that often, and when he does, he's got something to say. And a month ago, he was saying, I'm not so sure it's wise for states to be opening, but that's why we have a federal system where states can do what they do. And he was somewhat critical of Georgia. Here he is coming in and talking about a more populist line. I mean, I think there's politics attached to this. I think there's economics attached to this. And I think it's fascinating. The bottom line is it's what's happening. And I do think Lloyd Blankfein jumping in when some might have expected him to be one of the folks weighing in on a more conservative tone to lay low and let the virus, be the number one concern. He's saying, you know what? The economy might be the number one concern right now, and Lloyd Blankfein is someone we all listen to.
The point that you made earlier on our call to get ready for the show, Tim, was really interesting, and that is that Lloyd Blankfein is a registered Democrat. That is a known fact. And so for him to come down and break down sort of the political divide, unfortunately, the issue of reopening the economy became a political one. And so he sort of breaks down those barriers at this point, Dan Nathan, and maybe we'll have a much more sort of robust discussion about the cost to the economy, the cost to livelihoods, all of these other sort of things that we need to weigh when deciding to reopen. It's not just who's going to get sick and are the hospitals overwhelmed.
Yeah, I think the political one is kind of a curious one. I look at this this tweet from Blankfein. It's kind of bandwagonish. I don't think that he's saying anything that most people in this country don't already feel. And so to kind of make it a political thing is kind of goofy. New York State is obviously the hardest hit state in all 50 states, one of the hardest hit regions on the planet here, and it's a blue state. California, also a blue state, took some pretty significant measures even earlier than New York State. They represent 25% of the U.S.'s GDP. I just think it's kind of a goofy political argument here, red state versus blue state. Everybody wants to get back to business. Everybody wants to get to normal. The quarantine and the shelter in place was to avoid a health crisis bigger than what we were going to face as far as the deaths from the virus, and we've successfully done that. I think everybody is in agreement. We need to get out of our homes. We need to get back to work. We need to be safe about it. I think there is a sense of irony, though, that the people who are waving the flag the hardest to get back to it are the very ones who will not listen to the scientists and will not wear masks and do social distancing. So, we're going to find ourselves in a very weird situation for the balance of this year until we get more therapies, and really progress on a vaccine. So I think investors who are thinking about this through the stock market lens should be fully prepared for flare-ups and potential further lockdowns. And that is the real worry, I would say, as far as risk assets are concerned for the second half of 2020.
I guess I bring up the political aspect only because if it does seem that everybody is sort of getting behind this message at this point, it does seem that way, that's sort of the prevailing sentiment at this point, that perhaps what the stock market is riding on, BK, is not just hope. I mean, it's sort of like we are here and we have made it to the other side. And isn't that a reason for the stock market to be higher?
Yeah, certainly. I think that's one reason why, is people have kind of looked through the valley, as the cliche goes, and said, hey, we're on the other side of this. The country's reopened, by the way. I mean, it is reopened. The whole country did not really even shut down all that much. I don't think we're going to have a lockdown ever again in this country. Based on the people I'm talking to and what I see, I don't think you lock this country down again. I also don't think we have a second wave. I think we just have one giant wave as we go for herd immunity. That's really the choice that we've made, whether it's political or not. That's the choice that we've made. So investors have to be prepared for that. And if the investors are saying, hey, listen, as long as these companies can hold out until we get back to some kind of normalization, then all right, then I'll hold on to these stocks. But if you don't think that that's going to happen, if you don't think the liquidity is going to be there, then you have a problem with the stock market. Nonetheless, I am sympathetic to the Yep.
No, I was going to say, you mentioned herd immunity and this notion of this giant wave. I don't know if you guys caught the interview with Ricky Sandler of Eminence Capital on Squawk on the Street. I believe it was yesterday, but he wrote this open letter. And one point in his letter is that, maybe we should all just try and accomplish herd immunity. He could see a world in which there are concerts where young people go there, they catch the virus, and you develop herd immunity. But, does this mentality, Tim, pave the way for investors to accept, if this is the outcome that we're going to go for, and we're going to brace for this wave, and so therefore, when it comes to the coronavirus and the pandemic being an impact on a trade, it's much easier to sort of digest if that's the base case scenario that you're factoring in.
I think we've digested a lot of this scenario already. And when you think about that, we've gone through an earnings season largely completed. In some cases, especially in mega cap tech land, actually very resilient, stabilization, those types of words were used. So investors and the market are looking at three things. They're not looking at 2020. They're looking at the end of 2021, and that's how we're all doing our earnings multiples at this point. And fair enough, I don't know, but that's it. 2020 is a mulligan. Central bank mania. So the Fed is out there. Powell is basically continuing to talk about his bazooka, much like Paulson did. And this is a case where we've had this enormous fiscal and monetary response. Monetary has outweighed fiscal. Fiscal's been decent. Threats of more fiscal or maybe more fiscal. And then finally, you have a case where what's going on truly in the economy and what we've seen in China is that you get a pretty quick snapback, but then you start to level off. And that, in fact, you are starting to see some of the pain of a lot of companies actually, coming back at 70% of where you were is awful. All right. So I think that back to herd mentality, back to what we do. Should we be here in the stock market? Probably not. But we've done this with central banks before, and I think largely removing at least the credit obstacles that were in the market is part of why the market is able to now take that next step forward. So I think the market's in herd mentality right now. And Dan even referred to, we're going to just kind of get on with it. And there's going to be some painful moments here in the next 6 to 8 weeks, if not 6 to 8 months, as we realize that we're not coming back. And our kids are probably not going back to school. Makes my kids pretty happy. But I bet the fall's very different than last fall.
Dan?
Yeah, I just think that the difference this time to the last crisis is that the economy is fundamentally changed. To Tim's point, you're lucky if you're a business and you're coming back at 70% of your prior revenues. The way that you have to sell your products and services going forward is going to be totally different. The costs are going to be higher. You're going to employ fewer people. So I think what the market doesn't discount right here is the fact that, fine, we may not get slammed with a second wave. We may not have further lockdowns, but until there is a vaccine, the economy is different. There are going to be way more people unemployed. That means way less discretionary spending here. And so I just think that there's just no focus on that whatsoever. So we may spike up to 25% unemployment. We are likely to settle in somewhere for the balance of 2020 and 2021, somewhere double of where we were at 60-year lows just 5 months ago on the unemployment. You tell me that you get a V reversal in the economy like that, you're lucky at 2021 if we're back to prior levels. And I'll just make one point on valuation. The S&P 500 is trading over 20 times 12 months out PE right now. That's well above the 17 average over the last 5 years and the 15 average over the last 10 years. So at some point, I think the market has clearly reversed. I don't think there's anyone on this program who didn't think that was going to happen at some point. It's just overshot largely because of that bazooka and then the uncertainties about the economy. At some point, we'll seep in this summer, I suspect.
All right.
Some really major news from Moderna this morning. I think these are the first human data we're seeing on a COVID-19 vaccine program.
Up by 20% on this news. The futures themselves are picking up.
Moderna, the stock of the day, the pharmaceutical giant that announced today some promising results, early results in its vaccine trials, just announcing a secondary offering.
If the vaccine were to be successful, the stock would be 30% higher where it is now, and there would be a better time to do a secondary. So label me skeptical.
Story from Stat News. It's getting some attention this afternoon and potentially moving stocks. The headline, vaccine experts say Moderna didn't produce data critical to assessing COVID-19 vaccine.
Stock sold off sharply into the close. Moderna, of course, finishing the day sharply lower.
We stand by what we say. We felt as a company, following obtaining the results which just occurred, that it was prudent for us to add to our resources and invest directly from our balance sheet.
Even though it's a small number of individuals and it's the first step in a multi-step process, it was still very encouraging.
And there you have it. Story number 4 this week. Moderna, the stock taking Wall Street on a wild ride. This is the ultimate hope trade for the markets, for the economy, for biotech, for humanity. You might as well throw that in there, too, because we're all hoping for a vaccine there. Brian Kelly, what do you make of a trade like this? And it's not just Moderna. We've seen this time and time again with smaller biotechs that are really moving on the hopes that they are somewhere closer in some form or fashion to a vaccine.
Well, right. And this vaccine, clearly, whoever comes up with the first one, it's going to be a blockbuster vaccine for them. So, you know, we saw a lot of hopium on this. Again, you know, there's 8 out of 8. Some doctors say that seems to be pretty good, but it's 8 people. So you're subject to these things, the stories like we saw that, hey, maybe there weren't enough people. Well, you know, I took Stats 101. I know that if you only have 8 people in your sample size, that's not really statistically robust. Nonetheless, I am hopeful. I hope we get a vaccine. I want to go outside. BK likes to play outside. So, you know, I'm looking for that. But in terms of investors, this is just pure hope right now. Nobody has any idea whether or not this is going to work. If it does work, can they manufacture it? How long it takes to manufacture it? Who's going to be the first people to stick this thing in their arm and see if they get sick? Oh, yeah, and by the way, we need it for a couple billion people.
Yeah. Oh, and by the way, governments want it for free. I mean, we don't know how much money these companies will actually make, if anything, on any of these vaccines. When you take a look at billions of dollars in market cap, you know, 3 or so in the case of an AstraZeneca, or, you know, for Moderna, a 20% stock pop, Tim, you have to back up and wonder, is that market cap being added? Is that even going to come into play when the company releases this product in terms of making money?
No, because as I was reading research reports on that day, on especially also with the secondary, they were raising that extra 1.3 billion to, you know, work towards the actual dosage, not only to complete the testing, and then, you know, they start talking about a billion doses at $10 a pop, and wow, this could be a $10 billion revenue for the company. I mean, that kind of calculation is really irrelevant right now. First of all, Moderna was S&P optionality. That's what it was this week. In the same way, the Gilead announcement of 3.5 weeks ago or 4 weeks ago Friday, I think we were on this show, and I think we talked about that. It might have been right before you came back, Mel. So it was a case where I think, you know, if you look at all of the biotech news, it's news for humanity. But ultimately, when I look at biotech, I look at, say, the IBB, which use that as your proxy, the ETF that is the 6 or 7 largest biotech names that make up the top 50% of it. That stock, that ETF, was trending higher for the last year. Biotech stocks, especially in an environment where people have been concerned about balance sheets and people have been concerned about earnings, you know, Regeneron, Amgen, Gilead, you know, Gilead, even with its issues with HCV and HIV drugs that have seen their best days, these are still cash flow generating companies, and these are still great balance sheets with a fair amount of optionality. That's why I think you were buying biotech before COVID-19. That's why you should be buying them now. And basically, Moderna, Gilead, Abbott, you name it, AstraZeneca, these were S&P options for the market.
For right here, right now, though, Dan, I mean, Tim brings a good point in terms of the trend in biotech prior to the pandemic, prior to this whole notion of a vaccine coming about. But given that there is some froth, and we talked to Michael Yee over at Jefferies, and he said that the flows into the biotech ETFs has been very strong in the past few weeks, and he believes that most of that flow has been retail investors. Weak hands, in other words.
That's a great point, Mel. I was on that night when we had him on, and when you think about it, I think BK used the term hopium. Listen, it's really funny, right? Like, stocks are supply demand, right? The stock was a teenager in February, and then it traded as high as 85 after the news came out that they had, possibly some good data on this vaccine. I mean, give the people what they want. They want to buy your stock, sell the stock to them. They did it in a big way. They put $1.2 billion on their balance sheet, which basically ensures their survival no matter what happens with their success on this vaccine. Let's hope that it's good data. Let's hope that it was on the up and up, the whole process. But I don't know how you can kind of argue against that. One last point I'll just make is that if you're looking at the options market, the expectations for movement continue to be just crazy, off the charts. Looking a week out, the options market is implying about a 10% move in either direction. Looking a month out, it's looking like a 25% move in either direction. So my point to retail would be understand what you're buying. Tim just said optionality or this and that or whatever. Those are very expensive options, especially after a stock has moved 250% with very little data.
Yeah, I actually think that's a great point that Dan brings up there, right? You're talking about something that's going to move 25% in multiple weeks. If you're out there as a retail investor, and we just did a story about how some people are taking their check from the government, putting it into the market, you're just ladling on top of this. If you're going to be playing options, you're ladling on leverage on top of an already volatile underlying stock here. So to me, it's extremely risky. It's a lottery ticket at this point in time. But I do think Tim makes a good point. This is like a call option on the S&P 500. So to me, if I'm going to do that, why not just buy the S&P 500 calls with the VIX down here below 30? Much better way to play it.
We're counting down our top 5 stories of the week. 2 down, 3 to go, but we've got to take a fast break. It is Memorial Day weekend. So I have to ask, does anybody have any travel plans? Tim, you going anywhere?
I'm going to be wearing out a path between my house and my smoker. Mel, I know you like to do a nice 13, 14-hour brisket smoked, very slow on the smoker, kind of that old-fashioned choo-choo train thing. So that's what I do. And that's what Memorial Day is all about in my house. So I wouldn't be going anywhere anyway. And this year is extra focus. I've got a 16-pound brisket. I think it's going to take me 12 to 13 hours. Take the over-under, obviously chilling some Budweisers along with that, waving the flag, drinking, that's Memorial Day, right? That's what we do.
I mean, Dan, I've seen some pictures of your barbecues. They look awesome. I don't know what if that's going to happen this weekend.
Mel, our invite must be in the mail, or because Tim's barbecue sounds
don't worry, Dan. Don't worry.
Amazing.
It's on its way.
Yeah. Well, listen, mine's a bit more sentimental. I mean, Tim's just going to do the beef and the beer. I'm missing my parents here. I haven't seen them in 4 months. I'm going upstate. I'm going to see my parents, my sister. I think, my nephew. I think this is one of the things that I think we kind of, as a species, kind of hit a breaking point of being kind of caged up at this point. And it speaks to what we were talking about earlier in the show. We're ready to go out and interact with some other people, but we got to be safe. We got to wear a mask. We got to do the hygiene, the social distancing, that sort of thing. And I think that's going to be the real test for this country. We did a great job in this lockdown for the most part. We flattened the curve. We got to a point where we can kind of handle this thing as we move towards herd immunity. But now it's really important, actually, I guess, reconnect with our loved ones a little bit. And Mel, I'm missing you. I haven't seen you since February. So, maybe we'll get a little smoked brisket and some Budweisers going this summer.
This has been the longest period in my life that I've been away from you guys. I mean, in however many years, 13 years. And it really hurts. I really feel it. It's just not the same. I mean, it's nice to see your shining face, BK. I love seeing the dog run around in the background, but it's not the same as being face to face.
Yeah, it's not the same. And Ellie and Tallulah over here want to be on TV. They think they're superstars. But it is not the same. Like Dan said, as human beings, we want this contact. But I think it's right when you think about how you're going to travel in the next, let's call it 6 months or so, it's unlikely you get on a plane. At least it's unlikely for BK to get on a plane. But I'll hop in a car. I'll see family or friends that I haven't seen. Kind of make that, the quarantine, I think is the word everybody's using now, is get your quarantine together. People that you know have been kind of at home, haven't necessarily been exposed or at low risk of exposure. I think you see a lot of car travel. The other thing is business travel. Let's talk about that. I mean, I had planned in this spring, March and April, I had planned a trip or two to Asia. Everything that I had going on there got canceled, and it's unlikely I will go to Asia until 2021 at the earliest.
Right.
It's socially acceptable now for me to do this type of thing. So, why wouldn't BK hang out and do that? He doesn't have a fancy smoker. He doesn't smoke things like Tim does. I do get invited to his barbecues,
BK, you got
unlike
a boat.
you guys. But
I want to go on your boat.
I do. It's a dinghy. It's a dinghy.
All right.
I want to get on your boat.
We are counting down the 5 hottest stories of the week. Number 3, China. Tensions rising this week on several fronts. Let's get to Kayla Tausche for the very latest. Kayla.
Melissa, China acknowledging it cannot control the economic toll of the coronavirus. The country this week scrapping its annual GDP growth target for the first time in nearly 3 decades. But the Chinese Communist Party is seeking to impose control where it can, introducing a new strict national security law in Hong Kong that would crack down on protests and gatherings, and critics say it would likely strip the semi-autonomous territory of the few freedoms its people enjoy that mainland Chinese do not. Stocks in Hong Kong fell more than 5% today as global leaders widely condemned the new law, which could go into effect in late June. Secretary of State Mike Pompeo said for his part that it would be a death knell for the high degree of autonomy Beijing promised for Hong Kong, and that enacting it would cause the U.S. to reevaluate its policies toward the territory. Now, with tensions mounting in recent weeks, the U.S. has taken a series of actions to limit business and investment with China. The Labor Department discouraging federal retirement funds from investing in indexes with Chinese stocks. The Senate this week passing a bill threatening to delist from stock exchanges companies with Chinese government ties. And the Commerce Department just today announcing 33 Chinese companies will be banned from doing business with U.S. counterparts. Americans, too, have become increasingly wary of China. In a recent Morning Consult poll, 31% of respondents described China as an enemy. That's a rise of 11 percentage points just this year. And Melissa, the rhetoric will only get hotter, with President Donald Trump and Vice President Joe Biden spending a reported $12 million on campaign ads just about China. Melissa?
All right, Kayla, thank you. Kayla Tausche in Washington. It's been sort of a drip, drip, drip of increasing tensions, Tim, and it seems like the market at every turn has been sort of inured to it at this point. How much of a mistake is that in your view, or should we look past this?
I think we cannot be inured. If you think about what the headwinds were on the trade front, there's just, effectively doing that, and maybe and then some. I mean, the nationalization and security measures against Hong Kong are very significant. And remember the Hong Kong protests, and remember that was almost independent of trade war and what that meant, and the concerns around Hong Kong were important. The fact that China has scrapped their GDP forecasts, it's kind of like the CFO in today's earnings results of any company. First of all, I actually think that's good news. I don't think it's bad news. But between what's truly going on the trade rancor, and that is being ratcheted up, obviously when Congress is teeing up legislation against Chinese companies listing here, you're seeing folks like the NASDAQ being very concerned and enacting more stringent rules. You're starting to see what gives way. Alibaba had been very defensive. They had numbers out also, and those were fine, but finally gave way. And if you look at the EEM, which is 12 or 13% between Alibaba, Tencent, China Construction Bank, and you have a lot of exposure at the top of that for emerging markets to be exposed here. So this was a very difficult week. I'm long Alibaba. I think the fundamentals there are very, very solid. And if I look at mega cap tech companies and I look at secular trends that are going on in China, their online spending is up 80% year over year. I love that, but I hate this news, and I think it's going to get sloppy.
It's just interesting, Tim. You mentioned Alibaba, and they've really had this benefit over the last 10 years or so of this emerging middle class of the Chinese with all of a sudden just this disposable income to spend. And obviously that's becoming far more nationalistic. I think them pulling their GDP targets and their really slowness to kind of put in some stimulus for their economy tells you that things might not be going nearly as rosy in China as we think. And President Xi is in a tough spot. What I take that back to is that he cannot look weak in front of Donald Trump, who might not be president come January 21st, 2021. And I think there's a dramatic potential for this thing to escalate over the balance of 2020 because just like Trump can't give in an election year, President Xi is got a lot of pressure. And I think the Hong Kong news this week is the most important thing going on because we kept our mouths pretty silent when there were hundreds of thousands of people protesting in the streets last summer because we were trying to get a trade deal done. To turn that thing upside down now and be very hawkish about it, it looks, I don't know, it looks pretty political. So to me, I would expect this China thing to stick around, and it's not going to abate before the election. And I think that will be a headwind to growth globally.
Yeah, you know what? It is a headwind. And you know what's interesting? I'm actually really digging this kind of long-form fast money. We get to talk about a lot of different things. So BK is going to take a second here, and he's going to talk a little bit about what we're witnessing is what people call Thucydides' trap. Not people, it's actually what it's called, Thucydides' trap. And it describes what happens when you have a rising power challenging the former power. And that's exactly what's going on. So you can look back in history. You can see this would happen with Great Britain and the U.S. It's happened multiple times throughout history. Unfortunately, it doesn't really end that well. And that's why I think this is probably one of the more concerning things that are going on out there. I mean, best case scenario, you end up in some sort of trade war and or deglobalization, which I think is happening anyway. Worst case scenario, you end up in some sort of kinetic conflict, which is not great either. I don't want to be in either of those. So I do think you have to keep your eye on this. I do think you have to keep your eye not just on Hong Kong, but let's also remember Taiwan as well. China changed a wording in how they're going to kind of reintegrate Taiwan from a peaceful reintegration to simply just an integration. And that's very big when it comes to kind of signaling on the geopolitical landscape. So I think you watch this space. To me, it is probably one of the bigger things, the bigger threats to markets in general.
All right, let's bring in Clete Williams, the former deputy director of the National Economic Council, for more on this emerging threat coming from China. Clete, great to have you with us.
Thank you.
As you interpret what has gone on this week and specifically interpret the abandonment of the GDP forecast, national security laws in Hong Kong, trying to integrate Taiwan. I mean, how do you interpret these actions, and what do you think Xi Jinping? It seems like he's on his back foot right now.
I think that's right, and I agree with a lot of the previous commentators in that this is a very worrying escalation, and I do think it's something the markets need to be paying more attention to than they are. And I mean, the stuff that's happened in the last couple of weeks is mind-boggling. You know, you have China being increasingly assertive, very provocative moves this week on Hong Kong. I think that the language change on Taiwan is significant. They've got, what they call their wolf warriors on Twitter, out there attacking the U.S. administration, attacking the U.S. president, which is a very big change in tone for them. So I'm very worried about that. You look what's happening in the U.S. and all the actions that we've taken, whether it's the export controls or the changes in our investment programs, the possibility of delisting of stocks. Now, I want to be clear. I think some of what we're doing is very justified. I mean, China is an international outlier in terms of not providing our regulators with access to audits so that we can assess financial viability, and we need to do something there. But what worries me is just the frequency of the actions on both sides and the language that accompanies it, language where we're essentially calling each other the enemy. And so, I mean, I see this major escalation. I don't know what slows it down. One of the others mentioned the Thucydides trap. I mean, I think you do see some of that going on, and the way to get out of that is really for the international community to step up. If China sees this as the U.S. being threatened and trying to keep it down, that elicits one kind of response. But if China sees that it's an international outlier, then maybe we have hope to get off of some of the worst outcomes here. And so we really need to see others step up on all of these issues.
I mean, that would be ideal, but we've seen this time and time again in terms of tensions between the U.S. and China. It's always been it's been bilateral, and that's the way the two sides, or at least that's the way the U.S. wants it. And so, if that's the case, Clete, what do you think? If this is a tit for tat, and China's going to retaliate, what is the retaliation? What is the most likely method of retaliation right now?
Well, it depends on what the issue is. I mean, what China always likes to do is act reciprocally. They like to try to maintain the moral high ground by saying, oh, the U.S. did this, and therefore we're going to do something in the same sector. When we raise tariffs, they raise tariffs. When we do things that relate to investments, they'll do things that relate to investments. So I think it depends on the issue. But I think in many ways, what you see on Hong Kong, what you see on Taiwan, already is a response. They see this dynamic shifting in the U.S., and they are therefore becoming increasingly assertive and throwing their weight around, trying to throw their weight around on the international stage.
Right. Clete, great to speak with you. Thank you.
My pleasure.
Clete Williams. When the trade war was going on, and I guess in theory this is another form, another iteration of a trade war. But when that was going on, Dan, we saw the tech sector hit very hard. People assumed that the supply chains would be disrupted, that companies would be forced to move out of China. How does this ramp in tensions escalate that or accelerate that?
Well, think about it, Mel. From a scarcity standpoint for growth stocks, obviously China was a place that was of great interest. Just look at Alibaba over the last 5 or 6 years since it listed here. Tremendous ownership here, but I think it reinforces the mega cap names that are not in China, the U.S. names that are listed here. You look at Facebook making new highs, this week. Amazon again, not in China. The Apple is the real issue here, right? They have their phones and their computers made over there. There's millions of Chinese through contract manufacturers. They're employed to do that. The supply chains exist around that. They have very special treatment by the Chinese for this. So, to me, Apple, again, is always going to be the last battle fought in the trade war. But again, they don't seem to care, or at least investors don't right now. It's really hardware ones that I'd be most concerned with right now.
We're continuing our countdown to the 5 biggest stories this week. Our number 2 story, Joe Biden, the former vice president and presumptive Democratic nominee targeting Amazon on CNBC this morning.
I think Amazon should start paying their taxes, okay? I don't think any company, I don't give a damn how big they are, the Lord Almighty should absolutely be in a position where they pay no tax and make billions and billions and billions of dollars.
In that same interview, Biden's also pushing his plan to raise corporate taxes.
The corporate tax rate, I'd move back to what I had proposed at 28%. What we had proposed at 28%, because I want to make sure that we see that these corporations, that's not going to take them under.
Should companies be worried that the tax break they got is going to be taken away? Tim?
I think, politically, it's expedient to talk about attacking fat cat corporates that pay a low effective tax rate. I think targeting blanket higher corporate tax rates probably isn't terribly popular. I think targeting specific companies is easier. To me, this is not a political analysis show, but to garner the widest swath of votes, which means that you're actually you're throwing a bone to the kind of the mass population. And he talked about this $400,000 or less. You won't see higher taxes. That's an appeal to the masses. But I think the corporate tax cut that went through under the Trump administration was something that I thought was reasonably popular. How effective it was is the big issue. So going after some of these companies, I think, will continue to be a trend. And I think that's probably where you're going to continue to see pressure on a handful of those low effective tax companies. I think politically, the way to garner the most support is to not challenge lower corporate taxes in America.
Does this debate over corporate taxes change or get influenced by the pandemic, Brian Kelly? And I'm just thinking about, a Main Street backlash, Main Street wanting to be bailed out. They see companies paying low taxes. Why don't you pay more taxes so that we can have other programs to help us get out of this pandemic?
There's no question at all Main Street saying, where's my bailout? There's no question at all. I don't think we get through this crisis without there's being some kind of Main Street bailout. It's not going to be like 2007, 2008, where the people closest to the spigot, those who had assets, big equity holdings, were asset managers or banks, they're the ones that got rich, and Main Street's living standards didn't go any higher. I think that's going to flip this time. But I also think it's going to be really difficult to raise taxes. It's great to talk about in a campaign. It's really difficult to do. So where does that leave us? That leaves us with some sort of a monetary financing. People will call it modern monetary theory. You're going to issue a ton of debt. Fed's going to buy it. We pay for everything. And that's how we get out of this crisis. I'm not suggesting that that's the right way to do it. I think that's the path we're on.
Dan?
Yeah, I think Amazon is a pretty easy target. This is a company that's supposed to do $340 billion in sales this year, have about $10 billion in net income, and they have not been paying federal taxes over the last few years because of some tax loss carry forward and some other issues. And listen, we are literally printing trillions of dollars to bail out corporate America and our citizens for an unforeseen thing. But at some point, somebody's got to pay for it. And ultimately, I think you will see higher corporate taxes going forward. And companies like Amazon should be obligated to actually pay something. I think that's what the vice president said, enough with the trickery and let's do our fair share. I think it's interesting that last year we had this huge debate about billions of dollars of tax credits for Amazon going forward to come to, any number of different domiciles here in the U.S. I just think that, we get painted, if you're bearish on stocks or the stock market, you're not a patriot, you're un-American. You're hearing a lot of that stuff sort of right now. Isn't it kind of un-American not to pay your fair share when your market cap is $1.2 trillion and you're the richest man on the planet? To me, I think there's other ways to do your part and just paying taxes, even if it's at 21%. Which is what the rest of corporate America is doing at its max on a federal basis, makes some sense to me.
I just think that it's interesting that Amazon can be the target, but in this time of pandemic, it is one of the few companies in America that is hiring thousands of people. Yes. And also delivering groceries and keeping us entertained while we're sheltered at home. So, I mean, it's
hold on, Mel,
times.
Let me just jump in.
Sure.
Let me just jump in. And that's a great point, except for the fact that they're one of like a handful of retailers that were allowed to be open. And, Facebook issued this small business survey this week where they surveyed 86,000 small businesses. The numbers were staggering about how few of them are going to reopen. I think maybe 30% of them will not reopen. 50% of them will not hire back the same workers. So all of that, not all of that, you can't pin that on Amazon, but Amazon effect has a lot to do with that. Amazon, just like Walmart before it, is killing, mom and pop kind of businesses. So to me, at the end of the day, I don't know how you paint them with such a great brush like that.
Well, I think if you look at Walmart and you look at Amazon, they have been destroying the competition through price. And they can be loss leaders, and we've seen that. Look, Walmart puts, effectively is putting the crimps on every other retailer because they are taking major losses on food and groceries because they are dominating on price. Amazon has spent years investing in logistics and ERP because they saw this day coming, and they're turning the screws. Now, is it right to punish them for being that far ahead of everybody and having that type of infrastructure? I think it was important they were here.
And now it is the moment you have been waiting for. Our #1 story this week, the work from home boom. Twitter, Square, Facebook all announcing plans to let their employees work from home permanently. I sat down with California Governor Gavin Newsom earlier this week, asked him about it. Here's what he told me.
No, I think that was a trend line that will become a headline. I think we've accelerated change that was already underway. I think some are promoting radical change. I believe we're just accelerating change that was underway.
So that implies lots of ripple effects in terms of commercial real estate, in terms of residential real estate, Tim Seymour, in terms of what we buy. And that goes to how I teased, in TV parlance, teased this segment, and that is that this had to do with yoga pants, for instance, because you work from home, and you're not putting on real pants. You're not putting on a dress. You're not, none of that. You don't need that. You may not even need pants.
I don't need no pants. Don't need no pants. I don't need no shoes. I'm actually barefoot right now, and I'm not going to let you pan down. In fact, I'm in charge of panning down, so no one will see it. Guy Adami would hate. Guy Adami has a problem with feet, so he wouldn't want to see it either. But I'm not wearing shoes right now. I am wearing pants, and ultimately, I do believe that some of these trends were in place. I also believe that it was socially required to give this type of a mandate. As someone that's been an employer, not anywhere near of that size, I kind of like my people in the office. I think ultimately there are cost savings, and I think there will be efficiencies that are born out of this. And I do think less people will be going back to work, but I don't think this is the new corporate America. And I do think that there are major impacts for people like Starbucks and fast food and folks that are serving a commuter audience, and obviously Uber and Lyft. I think for the next year and a half, we will be in an environment where you will continue to see a lot of working from home. But I don't think this is the new normal. I think it's part of a progression of where technology has allowed us to work from almost anywhere. That's great, but the office is the office.
You know, Tim, you just mentioned Guy, and Guy's not here. He's a fabulous market prognosticator, but you know what? I got to tell you, he's also a great dad. He's at home. He's at home tonight celebrating Lily Adami's birthday. So shout out to Lily. Happy birthday. Guy, we miss you. You know, yeah, right. On this work from home thing, you know, I think it's interesting. It's obviously accelerated some trends. Technology has been a big part of that. But corporate culture is something that I think is very American thing here. We've done an amazing job. We're one of the most innovative countries in the world when it comes to technology. And a lot of that has to do with creating ecosystems and network effects. And I just don't see that changing much. So when you think about the two industries that I know best, Wall Street and even Silicon Valley, I don't really think they were meant to be decentralized. I think they're flexing right now because they have the tech to do it. But I think when we get back to a sense of normal, I think a lot of us will be back in those places. And I'll just make one other point. WeWork has gone from $47 billion to $3 billion valuation. If we do have a decentralized workforce going forward, WeWork is going to go back up to be a $47 billion valuation at some point in the next 5 to 10 years.
Shaking your head, BK.
Couldn't disagree more with what Dan said. Couldn't disagree more with what he said. I mean, first of all, I rented from
Guy?
WeWork. I was in there the other day. No, well, not about Guy, and particularly not about Lily. Happy birthday to Lily. I might as well throw that in there. But in terms of the flex, which I love that millennial term that he's using. He's very hip, this Daniel. But I was in WeWork the other day. Everybody was moving out. Nobody wants to be in that dense environment like that anymore. Not only that, I can tell you, I sent my team home in early March. I was concerned that we would lose something not being in the office. I wouldn't be able to operate my business. And I am shocked at how well I can operate my business in a decentralized and distributed way. That doesn't mean the office goes away, but there's going to be a certain percentage of people that just do not come back. And people have realized, hey, I can run my business from anywhere. I don't need to be in the office. It's going to have impact not just on commercial real estate, but residential real estate. Call any broker in upstate New York, in Hudson Valley or the Poconos. People are buying houses out there because they're not going back to work and they don't need to be on a train line. So I think this is a major shift. That doesn't mean you don't need big buildings anymore, but they're not going to be as full as they used to.
And it's great that BK is going to move to the Poconos. BK, enjoy it out there. The Mount Airy Lodge is actually heart-shaped tubs and whatnot.
The champagne glass pools, remember that? The champagne glass
tub is more my style.
Okay, go on.
That's right.
Exactly. But I think, you know, we've spent no time. We spent very little time, I should say. Great grammar, Tim. Talking about airlines on this show, and if you think about where Delta Airlines makes their most money, it's from business travel. And what has been essentially the lifeblood of airlines has been the ability to move business travelers around at almost costs that seem to be indiscriminate at points. So I'm worried about the airlines and how they recover from this, because at least it is a race against time right now in terms of cash burn for airlines. And while I do think we're going back to work, I don't think they're going to get back to full time. And as as I said before these guys started, my view is we're somewhere in between. I think we're going back to work, but it's very clear. You don't need to fly to London for that conference like you used to. It's very clear that Zoom or other offerings have changed the way we're going to business meetings, and that will change business travel forever.
And maybe people won't necessarily want to embrace work from home as much as we think. I mean, Facebook is saying, let us know where you're going to be based, and then we're going to adjust your salary. So there's no arbitrage. I mean, Dan, if you're thinking you're going to pull in a Silicon Valley salary and then live in Ohio, you know, where there's a lower cost of living, that's not going to happen, sounds like.
Well, here's the other takeaway. You know, divorce rates are going to skyrocket in America if we're all going to be working from home for too much longer here. So I'll just leave you with that. I mean, my marriage is doing great, but the rest of you guys, I'm worried about.
They seem all right, I think.
Save him, Melissa.
Exactly. Well, thanks, guys, for playing along. That was a fun hour. That does it for this special hour of Fast Money. What an hour it was, wasn't it? Have a great Memorial Day weekend. Be safe. Our CNBC special coverage, Markets in Turmoil, starts right now.